Good investing is not about what you know. It's not about how smart you are or where you went to school, how sophisticated the Excel model you have is. Good investing is overwhelmingly just about how you behave. It's about your relationship with greed and fear and your ability to take a long-term mindset, who you trust, how gullible you are, those kind of things. To me, the most important part is that behavior is hard to teach, even to someone who's very smart. You can teach them calculus and you can teach them data analysis. You can teach them how to read a balance sheet, but you can't teach people how to be patient. It's just some people have it and some people don't. That can be disheartening to hear, but I think it's really true. And all the evidence that we have shows that that is true. I don't think there's much evidence that people who are extremely intelligent are also going to be patient investors, or the opposite. The people who don't have a lot of training and sophistication, those people can be patient, very successful investors. And I think it's just very easy to overlook that in this industry, the disconnect between behavior and intelligence. I think there's a really powerful kind of logical idea that investors are playing the same game, that we're all investing in the stock market. We're often buying the exact same stocks. So therefore we're doing the same thing. And I think nothing could be further from the truth, that you have everything from high frequency traders on one end to pensions and endowments that have century-long time horizons on the other, and everything in between. And to think that those investors should agree on what the right price of a stock is, or agree on what news is pertinent, or agree on what the next best move is to do in the market is ridiculous. Like, we're all playing completely different games. And what's so important about this is that most investors who don't distinguish one game from another are liable to take their cues from investors who are playing a different game. So one example of this is, like, let's go back to 1999 and Cisco stock or Yahoo stock, whatever was big back then, is going up 10% per day. It's the 1990 stock bubble. Why is that stock going up? Is it because there are long-term investors who believe that Cisco is worth $800 billion or whatever? By and large, no. The reason the stock was going up is because day traders thought that the stock was going to go up between now and lunchtime. And by and large, they were right. That was the game that they were playing. The day traders didn't care that Cisco's market cap was well in excess of its future discounted cash flows. That's not the game they're playing. The game they're playing is the stock currently trades for $70 and I think it's going to 71 before the end of the day. That's their game. But that was really dangerous if you were a long-term individual investor saving for retirement, because you saw the stock going up and maybe you thought, hey, maybe these investors know something I don't. Maybe the stock is going up because this is the next wave of the future. And maybe the fact that it's going up says that that's a signal for me that I should be buying more before it keeps going up even more. So the long-term investors start taking their signals, their cues from the day traders. And of course, once the tide goes out, the day traders are gone. They've sold, they moved on, they did something else. The bag holders, so to speak, are the long-term investors who took their cues from someone playing a different game. If you were to watch CNBC and you go on and someone, the guy wearing a nice suit says, you should buy Netflix stock. Well, who is that advice for? Is that for a 19-year-old day trader? Is that for a 90-year-old widow on a fixed income? Because let's not pretend that those people are the same. So when someone says you should buy this, when we all play different games, then you have advice that is good for one person that will be disastrous for another. It's such an obvious, simple point, but it goes overlooked all the time in a way that I think maybe even the majority of bad investing behavior is caused by people who are taking cues from people who are playing a different game than them. I think a lot of it has to do with this concept of enough, that no matter what we're doing, and this applies to a lot of things in life, you have to have at least some boundary of saying, like, that's enough. And once I get to this point, I'm not going to reach as high. Like, that's just enough. Maybe it's possible to get more, but it's enough. I think it's a really critical investing skill. Look, if I can dollar cost average into index funds for the next 50 years, I'm going to achieve every financial goal that I have and then some. I'll be able to take care of my family in this life. I'll be able to leave some to my heirs. I'll be able to leave some money for the betterment of society. I'll be able to travel everywhere I want to go, live in the house I want to. Like, every financial goal will be met if I can do that. So why, if I'm currently doing that, why would I want to reach for more? If reaching for more is going to add more risk, that everything's going to blow up in my face, it's going to be more complicated, it's going to take more work, etc. Like, if I can already get everything that I want, why would I push even harder? What's the logic in that if I'm already getting everything that I want? And I know investors and fund managers who I have a good degree of confidence will outperform the market this year or next year over the next 5 years. So then the question is, why don't I invest with those people if I think they will earn returns above the index? And the reason I don't is because I think the more complicated that I make my personal investments, the higher the odds that I'm not going to be able to sustain it over time. If I were to invest in one of these fund managers, maybe I'll do very well over the next year or 5 years. But is that a manager that I can stick with for 50 years? Am I going to get to a point where I don't believe that they have their skills anymore, that I'm going to have to question them, that I'm going to have to pull out? Maybe I pull out at the worst possible time. The more knobs I have to fiddle with, the higher the odds that I'm going to interrupt my investing process at some point. Versus I think if my investment strategy is very simple, there's like no knobs to fiddle with. It's just the Vanguard total stock market. It's just so brainless. That's it. I think that gives me a higher chance of sticking with it for 50 years. And if I can stick with something for 50 years, compounding is going to go nuts. That's all it is. Like, all investing is just money and time. And the time is the most important part of that equation. So all I want to focus on is maximizing time. It's not maximizing annual returns. How can I stay here for 50 years? In most fields, the harder you try, the better you do. Like, if you want to become the best golfer in the world, well, go to the range for 12 hours a day and hit 1,000 golf balls. If you want to be the best basketball player, go live in the court and practice all day long. If you want to be a doctor, go study in med school for a dozen years. Most fields, there's a very strong correlation between effort and outcome. And investing is just not one of those fields. It's one of the counterintuitive fields where the harder you try, the worse you're likely to do. That's usually the case. Therefore, if you have a passive strategy, I think it just kind of tickles people to say, like, intuitively, that doesn't feel right. It feels like, of course, you should be able to do better if you try harder. Like, imagine if you wanted to become a good golfer and the strategy was like, oh, never practice, never hit a ball, never think about it, never read the golf news. That doesn't make any sense, but that is the right investing strategy for a lot of people.